Hi, good afternoon and welcome to Closing Bell Southern Africa. It is your wrap of the market today. We are coming to you live from the trading floor of Africa's largest lender by assets, that is Standard Bank, and we're hoping to have a good time while at it. But coming up on the show today, we will be tracking the market. Of course, the JSE looking set rather to finish lower, decoupling from some of the positive tone that we are seeing in other parts of the markets, the likes of Europe and the US. We'll get into the reasons why. One stock, however, that is going against the negative grain on the JSE right now, Sappi. Its shares at one stage surging over 6%. The company did release its results. We've got the CEO, Mr. Steve Binney, on the show just to take us through the numbers. And then just reflecting on a macro picture of what the manufacturing sector in sub-Saharan Africa is looking like right now. We are seeing mixed reports coming from the PMI reports that have been released so far. We'll be reflecting on the reasons why, but more importantly, just looking at some of the factors that could drive a more balanced and even recovery going forward. As always, you can let us know what you think about the show. The hashtag to use is a CBSA. Drop us an X at CNBC Africa, and you can reach me at Fifi Peters. But first up, we need to update you with what is going on in the world, right? And I'm sending you back right to the CNBC headquarters in Johannesburg, where Janet is standing by with those details. Janet, what is happening?
Well, Fifi, in your latest headlines, South Africa's mining sector shrank 1.9% from a year ago in September, after a downwardly revised 2% drop in the prior month. This marks the third consecutive month of receding mining activity, largely due to lower output from diamonds and metallic minerals. South Africa's Statistics Agency also reported that manufacturing output fell 4.3% in annual terms in September, with food and beverages being the major contributors on a monthly basis. Factory output decreased 0.5%. In other news, Namibia's annual inflation rate accelerated 6% in October from the previous month. This is the highest inflation reading in 5 months, driven mainly by upward prices of recreation and culture, alcohol, beverages and tobacco, restaurants and hotels, as well as transportation. On a monthly basis, consumer prices increased by 0.8%, the same pace as in the previous month. That's all for your top stories. It's back to you, Fifi.
All right, so just looking at the numbers as they are being displayed on my screen right now, we have the JSE All-Share Index down 0.38% or so at 72,190 points. The pressure seems pretty broad-based across the markets, particularly in the mining's complex, that down 1.5% at this stage, although we are seeing pockets of green in the industrial space, perhaps being driven by the fact that the rand is continuing its decline against the US dollar, currently at 18.152 to the US dollar right now, and we do know it does tend to favor some of these multinational companies that make the bulk of their profits offshore. But to help us better understand what is driving markets right now, I am joined by Sileo Tsatsi, Portfolio Manager at Anchor Capital. Sileo, thanks so much for joining us in the trading room of Standard Bank.
Pleasure to be here. Thanks, Fifi.
Sure. So let's actually reflect on what is going on right now. So the JSE is lower. I'm just looking at what is happening over in the US, and it's got a mixed picture. In Europe, the markets are looking slightly more positive. Just what is hot or top of mind for sentiment right now in your view?
Yeah, so Fifi, I think on our market, on the JSE, certainly China is a big driver of what happens on our markets. We had some pretty, I would say, disappointing inflation data out of China. And given that about, just 30% of our index is mining or resources, and that's obviously very China-driven. Then you also have things like process and NASPER. So we're quite a China-driven market. And given the fact that it looks like demand continues to be weak in China, I think that is weighing on sentiment at the moment.
So the China deflation story is essentially continuing, and we are seeing it at the consumer level, we're seeing it at the producer level as well.
Yes.
So I just would like your thoughts on what that ultimately means for money, this continuation of the deflation story in China, or whether there is an expectation that the government officials there, central bank officials there, might step in to do a lot more than they have been doing to try to stimulate that economy.
It's really fascinating to try and unpack that, because if you look at, for example, the property markets, you have the real estate market, which continues to go backwards. So in the third quarter, that was a drag on Chinese GDP. But at the same time, infrastructure spending has been positive, not to the level that it has been during previous times where they've been trying to get out of an economic rut. They've been a bit cautious or slower to step their foot on the pedal in terms of stimulus. But you have seen some signs that they are willing to stimulate. So I think it's a bit of a juxtaposition in the sense that parts of the Chinese economy are starting to come out of this post-COVID rut, but then other parts are still sluggish.
Okay, so let's talk about perhaps a sector that could be impacted by the ongoing weakness in China, as you alluded to, the mining space. Sibanye-Stillwater coming out with an update today. So they strengthening their foothold, as it were, in the recycling, the metals recycling business, purchasing yet another company, a US-based company that is in that space with operations elsewhere in the world. The share price did finish lower, down over 3%, I saw at one stage, but then again, most mining shares finished lower today. Your take on Sibanye and what they are trying to do, and whether the share price is the market giving this transaction a thumbs down?
Yes, so they've acquired, as you said, a recycling business. It predominantly recycles precious metals, so silver, gold, platinum, palladium, and copper. Now, the company has said that they want to diversify into green metals, the green metals business. And I think what's fascinating about this is that they timed the previous PGM bull market really, really well. And so I think investors now are questioning whether they can do the same thing in green metals, but they're trying to do this at a time where PGM prices have really come under pressure, and that's put their profitability under pressure. So I think there might be some concerns about the balance sheet and investing at a time when their core profitability engine has come under pressure.
So they've put a price tag or an enterprise value on that transaction at around $211.5 million US dollars, and they say that they'll pay just under half with cash, obviously the rest perhaps with debt facilities. UBS also made an interesting move today. Essentially, they've increased their stake in Sibanye-Stillwater. It's probably something that happened, a couple of days ago, but it's being reported on right now. So UBS now owning around 5.3% in Sibanye-Stillwater, whose shares are down over 46% since January. So the question is around whether you reckon that Sibanye is an attractive buy at these levels.
Yes, so in the short term, we're still quite cautious on the sector and the company. So we're cautious on the platinum group metals sector. Reason really being, we think that expectations for earnings going into the end of this year and the start of next year are still too high. So when we look at where PGM prices are today and we calculate earnings based on that, we still see quite a gap between where the market is and where we are. So we're still a bit cautious. Certainly the share has come down a lot, but we need to remember earnings or the profitability of the sector has also come down quite a bit.
So that's a no.
That's a no.
Okay, let's move on. So Sappi, the standout performer today, I mean, at one stage it was up over 6%. I see that it has retreated somewhat at these levels. And I just want to understand what you think it was. I know that they did make an announcement that post the year end, they'd be paying a dividend. And I want to know if that was a surprise factor that was expected. And if it was expected, what was it about the numbers that Sappi reported that the market liked so much?
Yes, so I think it was the difference between, again, expectations and what was actually reported. So the EBITDA number was about 37% ahead of what the market was expecting. The market was expecting $123 million. They did $168 million. Having said that, in terms of actual absolute performance, it was still a challenging quarter and challenging year for the business. For the full year, earnings were down 42%. They've also said that they expect their December 2023 quarter, so the quarter we're in now and will be closing soon, they expect EBITDA for this quarter to be below what they've just reported. And they've also recognized, and I think the market's aware of this, but they have recognized that their graphic paper business is in structural decline. So if we think of things like magazine or newsprint, obviously we're using that less and less. And so that business, I think, over the long term is going to be challenged. So I think the market was maybe a bit relieved or happy with the beat relative to expectations, but it's still a very challenging market or environment that they find themselves in.
So it was bad, essentially, but it wasn't that bad?
Exactly, yes.
Okay. We're at a bank, so I can't let you go without just getting your view and your take on banks right now. I mean, no need to make reference to Standard Bank specifically. specifically.
Yes.
But this is a sector that a lot of people have been talking about. It offers value, but we are in an environment whereby the headwinds are still very real. We do have inflation challenges. We've got consumers that are under significant pressure. These are guys that banks are exposed to. Just your take on banks and whether this is an area that you're looking in.
I think you probably summed it up better than I can. I think the South African economy, as we know, is under quite a bit of pressure.
Sure.
We know that the consumer is under pressure. But if you look at the JSE, for example, the resource sector we know has really struggled in 2023. We know that large cap stocks like Richemont, Naspers, Prosus have really come under pressure. And so I think to some degree, perhaps portfolio managers have looked at banks and the financial sector as a whole and said, this might be a bit of a safer, slightly less volatile place for us to almost hide in the short term. That's not the best way of putting it, but I think that's essentially what some investors have looked at it as. And so it'll be interesting to see going into 2024 whether that continues, because we do know that the SA economy has been under quite a bit of pressure, and it looks like that's going to continue going into next year.
Okay, so providing some comfort from now, but we'll see how long that continues. Sleo, I got to let you go, but thanks so much for taking the effort to come through to the trading floor here at Standard Bank, where we are broadcasting Closing Bell Southern Africa, of course. Sleo Tsatsi, a portfolio manager at Anchor Capital. We're going to a short break. On the other side of this, I believe we do have the CEO of Sappi, who will be taking us through the numbers reported today, as well as just speaking generally about the trends in the macroeconomy as they see it. Do stay with us. Welcome back. You are still plugged into a Closing Bell Southern Africa, of course. Now, you will recall that Statistics South Africa released some manufacturing numbers earlier today, just painting the picture for the month of September, showing a contraction which in fact was a lot higher than the market expected. But we have had quite a number of manufacturing prints coming from sub-Saharan Africa in the recent while, the likes of Kenya, Egypt, Zambia, Mozambique, Ghana, all coming out with their numbers, which have also shown quite a mixed picture, with pockets of growth in some parts of the continent and pockets of contraction in others. But to help us better understand what is going on right now and some of the elements that will need to be in place for a more balanced recovery in the sector, I am joined by Nasreen van der Westhuizen. She's the client lead for South and Central Africa regions global markets here at the Standard Bank Group. And Nasreen, thanks so much for your time. I must say we're having such a wonderful time in your working space. It's absolutely fun, and I hope we can do it a lot more. But bringing the conversation back to what we're talking about, manufacturing right now, obviously there are different push and pull factors that are driving the expansion in manufacturing and the contraction in other parts of the region that we are seeing right now. But I'd just like your take on the general trends that you are witnessing and how they are comparing to some of the expectations of the Standard Bank Group.
Yeah, absolutely. And as you said, it's a mixed bag. We've seen Zambia come out, and they actually came from a contractionary number of 48, just above 48, and they now above 50. One of the key reasons that we saw this move is that we've seen an improvement from a private sector perspective. We've seen new orders, we've seen output increases that have taken place, and so there's also an increase in customer demand coming in from there. On the contrary side, we see in South Africa, which is still sitting 8 months going down and sitting below their 50 market at around 48.9. It's not all bad in that, yes, we're contractionary, but you're still seeing businesses hiring. And so the expectation going forward is we will see this improvement, load shedding, we've got measures in place, etc. And as we start to see improvements in markets, that should start to turn. Not to be overly optimistic, like we said, it's really mixed. Mozambique still sits in like in an expansionary phase, sitting above 50, but we did see some pull down from there. Businesses have started to show a little bit of stagnation, reducing the inventories, etc. So going forward, it's watch a little bit carefully, but you will see this mixed bag, I think, continuing over the next few sessions.
Because I want to talk to you a bit more about the going forward. I mean, you mentioned the regions that are in expansionary territory, above that 50-point mark right now, being the likes of Zambia, Mozambique, and even Ghana, I see. And I just would like to get your sense on whether you think that some of the pockets of growth that we are seeing in some of these regions can be sustained right now against this backdrop, the global backdrop, where we're talking about a recession, how deep the recession will be, how hard the recession will be, whether a recession will happen. I suppose it depends on your view, but we have seen a slowdown in the global growth. We have seen the likes of, for instance, China, a key trading partner for the continent, not coming to the party as was initially expected. So against that backdrop, do you see a sustained recovery in some of the areas of growth right now?
Yeah, and I want to touch on China because I think you even spoke about it in your previous segment, a key component and a key partner for most of these countries. So, numbers have been mixed from a Chinese perspective, so growth is going to be somewhat subdued. So when you talk about sustainability, I'm going to say that it's not going to be fluid. I don't think we don't see it being fluid where you're going to see expansionary all the time. There are measures being put in place. We're seeing some positive growth. Commodity prices, for instance, in Zambia have been down, and we're starting to see a little bit of a turn, maybe going into mid next year roughly. But it's going to be a tough 6 to 8 months at least, and we need to get direction from the global market to kind of say, yes, we're going to see this growth come through. So in short, sustainability, in the short term, it's going to be very volatile, and there's going to be a few factors that are going to impact it. But going into the medium term, we should start to see that expansionary being sustainable for a while.
For a while.
Yeah.
Just a little bit more details around South Africa, just given the fact that we had data coming out from Stats SA, although, I mean, this is September data, and we've already had what the picture for PMI looks like in October.
Yeah.
But as you pointed out, to the fact that it has been continued weakness for several months right now.
Yeah.
Although, I mean, we do know that the sector has been trying to strengthen its resiliency against the power cuts. Certain things seem to be happening on the logistics front, but I suppose time will tell how soon that happens.
Yes.
It's a question around your outlook on South Africa's manufacturing sector and when you see that tide turning.
To be honest, from a South African perspective, yes, it seems positive. We're making progress. I would see it, if I had to talk to it as we're going along, as we go into next year, similarly to what I said with Africa, is that only towards the latter end. Yes, okay, they're making the right type of progress. Yes, things are changing, but you're going to have these in-between niggles, lack of a better word,
sure,
in the markets, in the sector itself. We've got factors that are not in our control. So, for instance, supply chain issues, etc., wars that are happening that can impact, supply. And then you've got inflationary conditions in South Africa. So, what happens from an inflation perspective is, will the demand then go down? So that is a matter of time. It's not a short-term quick fix that come quarter 1 next year we're smiling again. But the progress is happening. It will be slower.
Okay. So before the show, we spoke about currency devaluation, or central bank stepping in to make some moves across their currency markets. You told me that Malawi is a talking point right now. Something similar happened in Zambia recently. So talk to us about, as a bank, I mean, what you are looking at when you see these headlines, and ultimately what the market impact is.
Yeah, absolutely. I mean, so as I said, Malawi has been making headlines. It was out today. They devalued their currency from 1,180 to 1,700. So that's over 40% devaluation, which is quite severe. What they saw is that there's an imbalance between demand and supply. There's arbitrage creeping back into the market, and they kind of did a test to say, will import bills be paid at this new rate? So there's measures being put in place to support the markets from that perspective. Comes at the same time for Malawi as when they are negotiating with the IMF at the moment to extend the credit facility for $174 million, of which they are making a decision going into next month. So that is on the one hand. And then we had Zambia also come in at that point. Zambia depreciated over 20%. Sure. Year to date. So and they did it in a different way, where the central bank has actually increased the reserve ratio for commercial banks by for foreign exchange and local currency to help support the market. Remember, Zambia's been sitting with inflationary issues. There has been struggles. Yes, we just spoke about PMIs and that recovery, but overall, but there's definite stances from central bank to support the market and to make sure that we have an efficient, stable markets that are
Sure.
Yeah.
No, it certainly is interesting to see this central bank action play out across the continent, the likes of Egypt, of course, and Nigeria being prime examples that are also in that camp. But Nasreen, we'll leave it there for now. Thanks so much for your time. I was in conversation with Nasreen van der Westhuizen, the client lead of South and Central Africa region's global markets over at Standard Bank. So we wrap up the show right now with the best performing stock on the JSE, it would seem. Sappi shares at one stage rallying over 6%. The company did release its annual results a little earlier, which weren't the prettiest picture. Profits for the year down 52%, hurt by weak demand of its products, as well as a longer than expected destocking cycle from its customers. But of course, we did hear that the reason why we did see the big and strong rally in the share price was because the picture was not as bad as the market had initially expected. We've got Steve Binney, CEO at Sappi, for more on the numbers. Steve, thanks so much for your time. So I'd just like to begin with your take on the share price. I mean, most CEOs will tell you that they don't look at their respective stock prices on a day-to-day basis, but I think that you take a closer look when you are the best performing stock in the JSE and you do see a more than 6% run in your stock price. Just any comment on that?
Yeah, we're obviously pleased that the share price did rebound on the day. I think it's confirmation that the market likes the actions that we've been taking during the year. Despite the challenging economic situation, there's been a strong focus on controlling our costs and reducing debt, and we managed to do that. We're on a journey. We're repositioning the business, both from a revenue contribution perspective and from a balance sheet. Our balance sheet now is much stronger. It enabled us to keep our dividends despite the fact that the profits are lower. So all in all, the market liked that, and we're obviously thrilled by that.
Yeah, it was quite notable, the debt levels that you are talking about being or coming in at some of the lowest levels you have seen in the 3 decades, it would seem, about 30 years. But Steve, in your statement, you also guide for a challenging year, and some of the challenges and headwinds that hit you this time around essentially to persist. The weak global backdrop, the fragility in China's economy, these high interest rates, as well as this destocking cycle, where some of your clients are taking longer than you expected to actually, get rid of their inventories, as it were. My question is, which of those concerns worry you the most in the year ahead?
I think the picture has evolved as we've moved through the financial year. Initially, comparing it to last year, we had record profits last year, and we were always going to face a tougher challenge in the current year. One of the things that we benefited from last year was the fact that there was a shortage of paper in the world, and there was supply chain challenges. And because of that, a number of our customers built up their inventories, and we saw the rebound and the reversal in the current year. Now, that particularly affected the early part of the year. As the year has unfolded, the macroeconomic challenges that we've been facing have played a greater role. And, as you know, we've got the war in Europe, and that's had a substantial impact on energy prices and the prices for a number of our raw materials. But at the same time, it's contributed towards high inflation globally. And that's impacted consumers. Now, a lot of our products indirectly are impacted by lower consumer demand. So I would say, in answer to your question, it's been a shift away from destocking towards the macroeconomic environment. Now, it's not all doom and gloom, because in South Africa, we had our greatest profits ever. And we're very proud of that. And in North America, where the economy has been slightly better, we had our second highest year. Our biggest challenge has been in Europe, and that's where the global economy has been at its weakest. And it's getting better, but it's going to take further time in Europe for a full recovery.
Yeah, I mean, we have taken note of your moves in Europe to try and protect the business, as it were. The two mills, the one in Germany that you've completed the sale thereof, and the one in Belgium, whereby talks are still underway to, as I said, protect the business and position it for better growth. I want to circle back to the health of your balance sheet. Steve, that you did describe. You put the numbers to us, $601 million US in terms of cash on that balance sheet, $650 million US from unutilized credit facilities. What's the plans for that money? How are you planning to put it to work for growth?
I said earlier, we've got a strong focus internally on strengthening the balance sheet. For many years, Sappi had debt levels over 2 billion. We've been able to more than half that in the current year. And that has given us more flexibility, firstly, to withstand the economic challenges that we're facing in the short term, but also as we look to the future and the growth opportunities that lie out there. And our most immediate project that we're working on is a very exciting project in the US. It's to convert one of our big machines away from graphic paper towards packaging grades, which has got very exciting growth prospects. There's also an expansion involved there. So that's our most immediate project. It's underway at the moment. It's on track. And will be finished early in 2025. Beyond that, we haven't made any further decisions. But as I say, packaging is a very exciting growth prospect. The shift away from plastics towards paper for packaging purposes represents a big global trend for us. And then the other big segment where there's growth is in dissolving pulp. And for those listeners that don't know, dissolving pulp goes into textiles and clothing, and that market continues to grow, and Sappi is one of the global leaders in that segment.
Well, Steve, we'll certainly be looking out for the moves that you make as you further outline the strategy for growth by perhaps investments, more investments that could be forthcoming. But for now, we'll leave it there. Steve Binney, he's the CEO over at Sappi. That stock price finishing 4.92% higher, being overtaken, it would seem, by Alphamin, which rose 14%, it would seem, by the close. Vodacom, Advitech, Mondi, also positive gainers for the day. Circling over to the losers board, Anglo Gold, shares getting thumped, down 8%. The company did release a quarterly update for the third quarter, perhaps a reaction from the market to the details that lied within, as it does seem to be one of the few gold shares that have finished lower, alongside the likes of Sibanye, down 3.49%, and other counters, Bytes, True Words, and Life Healthcare, which also didn't have the best of days. But that's how we wrap up the show for today. Thanks so much once again for tuning in to Closing Bell Southern Africa, coming to you live from the trading floor over at Standard Bank. From myself, Evie Peters, as well as the team over in Johannesburg, it's goodbye for now.